Welcome to another session with Professor B. Today we're going to be covering problem 2-2 because some of you had a hard time with this problem, and instead of pinpointing specific areas, I'm just going to go through the whole thing just because it's such an important problem in this presented in this chapter. In this problem, it's an 80% purchase of a subsidiary with goodwill, and we need to consolidate the balance sheet at the least. Assume that Roland Company exchanged 14,000 of its $45 fair value shares for whatever, right? Right now, I just want to consider what the investment was from the point of view of Roland, and they have spent $45 for each share, and they've given up 14,000 shares. So the way I easily break this down is I always start with the market price, and they tell us the market price is 45 bucks there. We are also given the amount of par value, which is $1, and so the additional paid in capital or capital paid in excess of par, is a difference between the two, right? So as you probably recall from your previous accounting classes, whenever we record an issuance of stock, we always jot down the common stock line with par value. So in this case, this line is worth $1 per share, and they exchanged 14,000 of these shares. We also now know the paid in capital in excess of par was $44 a share. So I'm going to go ahead and put that here as well. 14,000. And the investment is worth what you paid. So the addition of those two items, right? The cost basis principle in accounting states that you are required to record investments in an asset, including an investment in a subsidiary, at the cost that you had paid for it. So that's step one. They also tell us that there was some sort of related acquisition cost, and cost in the previous problem 2-1 given was 40,000 bucks. So I'm just going to go ahead and record that as cash being paid out, 40,000, right? So both of those had to be filled out for it to have given you a correct mark. We've now determined that the parent company has invested $630,000 to procure the stocks, or 16,000 worth of shares of the subsidiary stock, right? 16,000 shares. We don't really care about the acquisition expense at the moment because that's not really part of the actual deal insofar as the value is concerned. And since we're going to be working on the value analysis, that's what we really need to work with. What is a value analysis? Value analysis lets everyone know what the implied value of the subsidiary's stocks were when you purchased it. See, in accounting, anytime you purchase something, that price you paid becomes a fair value of the said product. And so if you've paid X amount of dollars for 80% of a subsidiary's net assets, then that price is implying to everyone out there that you think that's the value of the said asset you've purchased, or net assets in this case. We know now that the parent company invested $630,000 and they purchased 16,000 shares. 16,000 shares. If you take a look at the actual question, it says that the subsidiary, or Downs, common stocks are worth $20,000 at each $1 par value per share, which means each of them is worth each of them is worth $1. So that means there must have been 20,000 shares, right? Even if you hadn't read the top part in problem 2-2 where it says it's 80% purchase, we can actually determine where they got that 80% number from. The subsidiary had 20,000 shares outstanding. The parent company purchased 16,000 of it. So that's a simple math. of 80%. The next part of the value analysis, it's a bit involving algebra, some basic algebra. So I kind of want to just explain that logic to you as well. And we're going to go through this in another presentation I have prepared for you. But just real quickly, if you paid $630,000 for 80% of the subsidiary's net assets, then what are you implying is the worth of the entire company, 100% of it? And if you were to set up the following ratio, that 80% is equal to 630,000, then what is the value of 100,000? 100%. And we set that ratio up like that, and we solve for x, which basically means we divide 630,000 by 80%, right? Because 100% is really just equal to 1. So that's the next step we need to take care, is we need to cross multiply to arrive at this point. We know that we paid 80% 630,000, so we can just jot that there. But what is implied for the overall 100% of the company's value is that divided by 0.8. And we figured that part out by setting up this equation. We cross multiplied and we determined that x was worth 787,500. So if that's the case, if that's the implied value inherent in this purchase, and we own as a parent 80% of that, then 20% must be the non-controlling interest. We subtract the two to arrive at that implied value that has now part of it, or 20% of it, belongs to the non-controlling interest. The next step in the value analysis is, of course, to determine the goodwill. And goodwill will be inherent anytime you have paid over and above the fair value of the net assets of the subsidiary, right? So that's the next thing we need to do, is we need to determine the fair market value of the subsidiary's net assets, excluding goodwill. It'd be one thing that if they had given us the fair value of the net assets, excluding goodwill, but they haven't done that. They've only given us some assets that were overvalued in this purchase, but we'll come back to that in just a minute. At this point, what I want you to do is I want you to just copy this first line down here. And because of the correct markers, it might not copy down. So I'm just going to individually paste things down here, and just make sure you paste the values. And that should be it. Let's try that again, just the values. Same thing, just the values. I'm pretty sure I could have just copied the line, but I didn't want to mess around with the markers there. All right, so we know that this is the fair market value of the entire subsidiary, the 100% of it. And we kind of backed out of that number because this is what was given to us as a fact in the question, right? So we determined that. We are going to actually skip on this previous line here and work on distribution and determination schedule, where we actually can figure out what the excess is down here, and you'll see how that works in just a minute. So go ahead and put that fair value of subsidiary up here in this first line, and then what we need to do is first we need to compare that fair value to the book value, right? Book value is what just appears basically in the books of the subsidiary. For them, the common stock line for Downs, for example, is $20,000. The paid-in capital in excess of par is 180. And again, this is all just given to you in the text, so I'm just going to jot it down here this way. Right? So this is what I just gleaned from the textbook itself, just looking at Downs book value for their equity section, specifically just common stock and paid in capital in excess of par and retained earnings. And I just added that here, right? That's just the addition of all those three items. And then next thing I want you to do is go ahead and copy the 340,000 in this cell and this cell. Again, you want to make sure that you are just pasting the values and nothing else. And then that'll make sense in just a minute. So if we acquired 80% of their company, that means multiply blue and red. In other words, we acquired 80% of the book value of their net assets, which is 80% of their equity components, which is worth 272,000. Right? And we can do the same analysis for the non-controlling interest, as we want to multiply those two items across. So let's go back. If the total equity is worth 340,000, that's a book value, that's what's on the books, and we are implying through this transaction that the entire company is worth 787,500, then generally speaking, or broadly speaking, nearly $447,000 is what we paid in excess of book value, over book value. That's what we really did, right? Now we just have to figure out what that 447,000 number is, right? Part of it is goodwill, you betcha, but it also has some other components, and luckily they give us this information in what is known as the adjustment of identifiable accounts. We just have figured out that we have 447,500 paid in excess over the book value of our subsidiary. What we want to do, what our task is, to determine where that number came from. Why does that number exist? So to help us along with that, we're going to employ another tool called adjustment of identifiable assets. And what I want you to do is I want you to take a look at the various items that they have identified here in problem 2-1, right above problem 2-2, where they say the following fair values are applied to Downs' assets. So the current assets for Downs was previously at their book value 70,000, and it's still a 70,000 here, so no change has occurred. They tell us that the inventory was valued on their books at 60,000, but according to us, when we paid this extra amount, this excess of 447,500, right? We're trying to identify what comprises of those items there. So we can see right away that inventory was valued at 60,000 previously, and now we've given them a value of 80,000, an increase of 20,000, right? An increase of 20,000. That 447,500 thus was in excess because 20,000 of part of that was attributed to inventory. Let's take a look at land. Land was previously worth 40,000. Now it's worth 90,000 after we paid a little bit extra money. So 90,000 minus 40,000, i.e. 50,000, is exactly right. Over here, this is the appreciation in land that we must record upon consolidation. And that's what we're doing all of this for, by the way. We're consolidating at the end of the year because consolidations are necessary anytime you have a parent subsidiary situation where the parent owns 80% or more of the subsidiary's net assets, right? So we're doing this as part of the consolidation procedures to furnish consolidated financial statements. And at the end of this process, we're going to go back to these two separate entities continuing forward with their respective businesses, and they're going to continue onwards the entire year doing their own thing. But at the end of the next year, again, we're going to do the consolidation to show what it looks like if the financial statements are consolidated, right? So this is part of that process. We'll take a look at building next. Building, they tell us And we're always looking at the net values, right? We don't care about accumulated depreciation. We just want to see what the book value is of an asset. So in this case, it was 120,000. But if you take a look down below where it says the following fair values applied to Downs' assets are as such, and they say building is 150,000, that means it was something was worth 120. We paid 150 for it. Thus, the difference of 30,000 must be applied during the consolidation process to this building, to this asset called building, right? And if you're going to increase a value of an asset, it is going to be a debit, and we've selected that correctly here. I just want to show you the logic down here. We're going to choose debit because that's exactly what we did. Exactly what we need to do, excuse me, to show that we are increasing the value of an asset, right? And if this needed to be a credit, then so be it. But for now, we're increasing the value. Equipment was previously valued at 110,000, and now here in our inherent or implied price that we have paid, it's 100,000. So we kind of lost money there for equipment. It went down 10,000 bucks, right? So minus 10,000, it went down. How do you reduce the value of an asset? You credit the asset, right? So I must credit the asset, 10,000. Excuse me. You'll notice that this column doesn't add up to 447,500 yet because we're missing out on a component called goodwill. And so basically, we're going to need to take this amount and subtract from it the sum total of all of these items that are here, because theoretically, that should be goodwill, right? So all I did was I added up all of this, whatever that came out to, I subtracted it from this amount, and now I know that goodwill is 357,500 paid in totality for this company over and above appreciations in asset, right? So you have the book value of the subsidiary, and remember, folks don't just go around increasing their book value at their whim. This happens when something is sold, right? So if a parent company comes along and purchases something and then pays something over and above the book value, then we must determine those amounts, because we're going to have to eventually get rid of the investment in this subsidiary in the consolidation process and absorb the subsidiary's net assets, right? That's the whole consolidation process in one bit. But that's what we needed to do. We needed to determine the constituents that are important in coming up with that total value paid for the subsidiary. I've determined the reason for this excess that was paid, and part of it was goodwill. We can actually go ahead and jot that information up in the value analysis, which we had previously ignored. And we're just going to set that equal to 357,500. In other words, someone came along and we had a goodwill of our subsidiary at 340,000. Somebody went ahead and paid 630,000 for 80% of that equity. And inherent in that appreciation was not only goodwill, but also a bunch of appreciation for assets as well, right? And all we're trying to do now is kind of back out and figure out what amount that goodwill was. So now that we know that, now that we have that part, we can subtract the goodwill from the excess price paid to determine really what the fair value of net assets was, excluding goodwill. Could we have come up with this 430,000 number? You betcha. So if you look at the current assets, the net assets, which are assets minus liability, we can simply go 400,000 for the total assets minus 60,000 in current liabilities. For Downs, that's 340,000. Plus we had appreciation of various items, including inventory, land, and equipment. So that would have been these items here. a total of 90,000. So 340,000 plus 90,000 that you see down here is equal to 430,000. And that's how we can confirm that this number is correct. We can also extrapolate this out. We know that 80% of it was the owner's share, so we can take 80% of that there, and we can take 20% of the goodwill and give it to the non-controlling interest, and this same logic can be applied to these two items here, right? So this should really be 86 plus 71,500. This really should be 157,500. Sure enough, we can check that. All right, moving onwards. So now that we have figured out what is going on in this problem, where we have purchased as a parent 80% of subsidiaries' net assets, we've determined what the book value was of the net assets, we've determined what the goodwill was, and we've determined what the appreciation in assets was, so to speak. Now that we know everything that's happening, now let's actually begin consolidation. I alluded to this earlier, but situations like this are necessary when you own 80% of subsidiaries. So imagine on your balance sheet, you have just imagine for a second if you have a bunch of investments in a subsidiary, and you recorded this initial entry to record your investment in a subsidiary where you really are the parent company, right? Because you own 80% of them. And you have a bunch of these investments in Down Company, investments in XYZ Company. It is sort of misleading to the end user when you really are the parent. Because if you're really the parent, then you really shouldn't even have an investment in a subsidiary on a consolidated balance sheet. In fact, this account really shouldn't exist in a consolidated balance sheet, right? What you really should do is just absorb the net assets, all of the assets and the liabilities of the subsidiary, and get rid of this investment account, right? That's what you really should do in a consolidation, because to the end user, it helps them understand that, oh, these are really your assets. Up to 80% of the subsidiaries' assets are really your assets. So if you just commingle that and get rid of this investment account, then it makes it easier for the end user to read the consolidated financial statements. Again, none of this will be recorded at the year end. It'll be recorded on a provisional basis to provide the consolidated statements, and then the two companies will extricate themselves from this merger or this consolidation, excuse me. Merger is not the right word, consolidation, and they'll continue to separately live out their lives as if they were separate entities. And again, the year after, we're going to do all of this all over again, right? Consolidation procedures. All right, so as I mentioned just a few minutes ago, what we really need to do is we need to get rid of this investment account. And these two items we can ignore pretty much because they're an income statement slash balance sheet items there for a period. We don't really care about this. The only thing that really matters to us right now is this investment in Downs. We want to get rid of it in the elimination process, and that's why it's called the elimination process, because what we're going to do during consolidation is we're going to delete this account, investments in Down Company, for 630,000, and we're going to absorb all of the subsidiaries' assets up to the extent that we control, 80%, right? And then we're going to leave 20% for the non-controlling interest, and we're going to make no attempt in identifying what that comprises of, right? We don't care. We just want to have a little bubble in the equity section that is not owned by us. Nonetheless, it is an important part of the consolidated statement, so we want to leave that there. So we want to get rid of this 630,000. To understand the first step, what we need to do is realize that out of the 630,000, there are multiple components, right? There's a book value, and we own 80% of it. So we need to get rid of that 80% of that book value first, right? So, and we already identified that the total equity or the book value of the equity was 340. 80% of it is 272,000, and we took that amount out from 630 to arrive at the balance. So these two amounts, if we got rid of them somehow, then we would cease to have this investment in the subsidiary, and that's really the goal here. So we're going to eliminate our 80% value of the book value of the equity first. That's our first elimination entry. Here we go. So investment in Downs, we want to get rid of that by 272,000, just because that is the most readily identifiable item on our sheet here. And we'll get rid of 272,000. It's an asset. Investment in Downs Company is an asset, so we get rid of that by crediting the asset, and we get rid of that equity as well, that we have control over in the subsidiary, and then we'll just absorb all of their assets together, right? So we know now that the common stock, just by looking at the textbook, is $20,000 on the subsidiary's books. 80% of that is our share. And I should have put an equal sign there, excuse me. And we're going to follow the same logic all the way down, right? We're going to follow the same logic, except the 20,000 for paid in capital changes to 180,000, excuse me, and 80% of retained earnings total is 140,000. And so what we've done is, let's ensure that we've got three of those items right. The sum total is 272,000, and we have just started eliminating 80% of our investment in the subsidiary by getting rid of 80% of our investment account. Remember, it was 630,000 total on our books, right? This is all we had under investment section. So we got rid of the book value component of it, specifically 80% of it, which is 272,000. 630,000, 80% of the book value is 272. We've gotten rid of that. And if we can get rid of this excess in the next step, then these two items put together, total of 630,000, we would have eliminated all of our investment in that company. All right, so now that we've dealt with the first step, let's deal with the second step, the excess, right? We paid excess. So that's a remaining component in our composition here that we need to get rid of. And while simultaneously we're going to give that excess appreciation to the NCI, to the non-controlling interest, right? By crediting their retained earnings for NCI, we have just increased their retained earnings, the 20% share, while simultaneously getting rid of our investment in Downs. And the remaining aspects of this, we have already actually kind of figured out. So this is where we're going to debit inventory for 20,000. I'm going to fix this a bit here. It doesn't want to move for whatever reason. Okay, fine. So inventory 20,000. We want to appreciate land on the consolidated balance sheet by 50,000. Remember, the initial part of it is already on the subsidiary's books. So when we combine it with this 50,000, it's going to have a net impact or net increase of 50,000 plus whatever the book value was for land, which was 40,000. So we'll eventually end up with 90,000 there. Good. Building, same thing. We want to increase it by 30,000. Again, that's what the debit here stands for. This is debit D3, right? Debit D3. That's where this line comes. This is where it's referencing to, right? So it's coming from here, which is telling us, hey, increase the building's value by 30,000 by a debit to building. And finally, the and no, not penultimate, I'm actually penultimate. Equipment needs to decrease by 10,000. And please remember to not put a negative here because a credit is already a reduction. So we don't need to show negatives here. It's a journal entry. So we'll leave that there. And finally, goodwill can go in this section here as a debit. Again, debit, the fifth debit we need to make in the elimination entry round. All right. So that's where we got the 10,000 negative for equipment as a credit, and then a debit to goodwill. Remember, goodwill is an intangible asset on the balance sheet. It is categorized under assets. All right. Are we right? Are we correct? Well, if we were to add up the debits, that's 457,500. If we add up the credits, that's 457,500. Gee, where I've seen that before. We've seen that here, except for the minus 10,000, right? So now that we've taken care of the 272,000, we've actually taken care of 447,500. So that pretty much comprises of the 630,000 total investment that the parent made. The 10,000 is throwing us off because this was really a credit, and in that computation up above, it was negative. So just a little interesting bit there. Anyway, so this entry matches what we've done through this entry. And along with the previous entry is we've gotten rid of 272,000 of the investment in downs, and then we've gotten rid of the remainder investment in down as 358,000 plus 272,000, total 630,000. We have eliminated altogether. It no longer exists, this investment account. What instead we've done is we've given a record of improving appreciation or values for these accounts, as well as establishing that there is some sort of a goodwill that exists now that somebody came along and paid theoretically more money for what this book value of the company was worth. Right, and that's what this bit talks about here too. Recorded the various elimination entries that'll need to that are needed to consolidate. I want you to go ahead and start recording things in the trial balance that's provided for you at the end of the worksheet here. And to help us jump back and forth, I'm just going to put in some splits. And maybe move this a bit higher. All right. So if you recall, the first thing we did was we recorded the initial investment in the subsidiary. So first we need to record that. We need to show that before we move forward. So right off the bat, we have a debit of 630,000 in investment in down. So I'm going to go ahead and jot that down. And we are also going to we're going to have to show that we paid by issuing common stock. Anytime we issue common stock, we have more common stock, which is down here for Roland. That's a parent company. And how much more? 14,000 and 616,000 respectively for par value, as well as paid in capital excess of par, right? And you can see that the correct markers show up here for us. Right. We also need to record this acquisition expense entry, which really didn't make it on either entity's books. Again, these are consolidation entries and elimination entries that won't actually be part of any company's books. It exists only to show the end user what the consolidated balance sheet would look like. So we need to record this expense as a reduction in cash to 40,000. And again, we're gonna take both of these items and just smush them together. We're gonna add them together. We're gonna pick up all of the assets and liabilities of the subsidiary, eliminate our investment in the subsidiary and thereby getting rid of these two items. But I'm getting ahead of myself. Let's just go step by step. We reduced our cash by 40,000 from the consolidated point of view, which is simply a reduction to other current assets. And similarly, an expense, acquisition expense, is really a reduction in retained earnings for the parent because they don't really have an expense account here for us. So I'm just going to reduce retained earnings for the parent by debiting it. And a debit is usually a reduction in an equity account. So that's also 40,000, right? And it tells us that this is correct. We're done with the original investment account. The next set of entries that we have begin here. They're aptly called the elimination entries because they help us eliminate the investment in downs. This is the item we want to destroy completely because we want to absorb all of the subsidiaries' net assets, and we don't want to have investments exist at all, which is kind of really what we were doing up here in these journal entries to begin with, right? So let's take a look at the elimination entry next. So we then said, all right, in the elimination and adjustment entries, we want to get rid of the 272,000 investment in downs. So investment in downs credits for 272,000. And so I hope you can start to see that initially we had a debit of 630,000, and then we are reducing that by 272,000 as part of the elimination process. And the debit side of this reduces 80% of the book value of subsidiaries, which is this down here, subsidiaries equity, right? So that's common stock for them, that's paid in capital for them, and that's retained earnings. So these items go down, or a debit to the equity section of the subsidiary. While we're here, we'll also get rid of the remaining investment in downs, which is denoted as entry D. Again, I've provided you with two lines here. I hope you can see that because this is really one account. We're really just affecting investment in downs. And again, this goes down by 358,000. And we increase the net, the non-controlling interest share by 89,500. We reduce the value of equipment. Sure enough, 10,000. Again, we're not going to put negatives here because we're in the credit column, which automatically denotes reduction for assets. And then we're going to record the remainder of these amounts here, 50,000 for land, building 30,000, and the fifth debit was to goodwill, 357,000. And sure enough, that's the row for it, 500, excuse me, for a total adjustment of 729,500 on as a debit and a credit. And now we are going to simply segregate the non-controlling interests equity by simply moving this guy over here, 89,500, just to show that these columns belong specifically to the non-controlling interest, and we're not going to break that down amongst its constituents. We don't really care about the non-controlling interest. We just want to show it on the consolidated as part of equity that's not under our control. The remainder of this column has to do with the balances. In other words, when we debited the common stock for subsidiary, there was already a balance for the subsidiary of 20,000. So if you had 20,000 in credits as far as common stock is concerned for the subsidiary and you got rid of 16,000 of it, you really have a credit balance of 4,000, right? And we can do that mathematically. Because this number here on the far left is already a negative, I'm going to click a negative before that. So a negative minus negative 20,000 becomes positive 20,000, and we want to subtract from it this 16,000 number here so we can arrive at that as well. And this I'm just going to copy and paste down because these two items represent basically the paid in capital and retained earnings for the subsidiary. And again, we just want to do the math across the way, right? So if you had 180,000 in paid in capital in excess of par for the subsidiary, and then we eliminated 80% of our interest in it, we really should have 36,000 left over for the non-controlling interest that we no longer control, right? We just want to identify that for them. And honestly, if you were to do that, the last column already has Excel formulas in it, which will update everything across the board, right? So it'll add up the beginning balances for each of these rows. So for example, you'll put together 70 and 50,000, 70,000 and 50,000. That's 120,000 total current assets that are owned by the consolidated group, minus 40,000 here. So 120 minus 40, that's 80,000. Excuse me, go away. That's really 80,000 balance here, right? And just like that, everything has been consolidated for us. And in fact, that is the correct balance and it shows correct. So this was our first foray into consolidations. This is going to come back over and over. It might get slightly more difficult, but the idea is always the same, right? Identify what the investment is for the parent, eliminate that investment, distribute, identify and distribute the excesses, identify the non-controlling share, and add up all of the assets and liabilities together in the consolidated group, and not show this investment account, right? If you notice, that line now is 0, and that's exactly where it needs to be. Again, this is not the easiest problem in the world, but it is doable. And the more you practice through these exercises, the better you're going to get. Please reach out to me if you have any questions, and I'll continue to provide you with these videos. I'm hoping they're helping someone, and you can look forward to that as well. All right, if you have any questions, please reach out to me. Once again, thank you so much for your time. Nice day.